A mixed day on the markets, and we are back talking stocks with Eugene Profit. Next is an email from Scott in Falls Church, Virginia. Wants to know about Ford. He says the PE is around 11. Prices dropped by half over the last quarter or so. Starting to climb back. Boy, well, one, generally, do you like it? But then he says, do you think it'll go back up around 50, later this year?
Well, Scott, I own Ford once upon a era. I don't right now. I think, and actually, the market pundits would say buy Ford now. When the Fed's cutting interest rates, you want to go into the automotive companies. They tend to outperform over an extended period of time. However, I think you see pronouncements that they're cutting sales. You see the part suppliers missing their earnings estimates, and I don't think that that's over. I think that they had a big run up because of the SUV fad, if you will, and that's over. Ford is probably the best positioned automotive company, so if I'm owning anyone in that sector, I would probably own Ford. But I don't own any in that sector, and actually I think I might go into Daimler-Chrysler to play the next leg of the cyclicals going up. And the reason is this. I think that the dollar is probably going to soften. By owning Daimler-Chrysler, you get a little bit of the euro play involved as Europe comes back. I would probably own Toyota because they're probably the best of the automotive group in terms of customer approval. But Toyota has so little float, New York Stock Exchange, that I couldn't buy enough. So I think I would probably push for Daimler-Chrysler to play the next leg of the auto cycle.
Interesting. What about parts makers? You mentioned problems there, but is there an opportunity?
They still are. We own Visteon, and we sold them, fortunately, because I think with Delphi and Visteon, they're very cheap from a price-to-book, a price-to-earnings standpoint.
You're a value guy. You must like that.
We do. But we don't see the catalyst unless the auto companies overall begin to move up.
Right.
Well, most of those auto parts suppliers are still beholden to one auto manufacturer, and until they spread that out and broaden that out, we find that to be too much of a commodity play.
Interesting point. We're going back to our phone calls, and Edwana in Florida is next. Go ahead, please.
Hello. Thanks for taking my call. I'm 67, and I own quite a bit of BellSouth stock. Also, I own some of VanGuard500.
Yes.
I've had this for a long time. Tell me what you think, and if you think where I have my money, it's safe, and what you think about the stocks I have.
Well, I think that if that's your total portfolio, you're okay. On the Vanguard 500, you primarily own an index fund, and it's managed for you, and you're going to get market appreciation, which would exceed inflation expectations, so that's a good thing. BellSouth, we like. I don't own it currently, but I think that you hear a lot of people looking for aggressive plays in broadband or in wireless, and when you get a regional Bell like a BellSouth, they're very strong in digital subscriber lines, but because they have access into the homes, because they have all of the other components of telephone, you have earnings ironed out, so you don't have the volatility that you'd have in a DSL play direct. So I would hold both. I think you're well positioned.
More broadly in terms of advice, she said she's 67, retired.
Sure.
Is there anything in general that an investor with that sort of profile should bear in mind, should be watching or looking at, should be careful about?
Yeah, well, I made some assumptions that she didn't need the money right away, that she didn't have to cash out of the market tomorrow. I assume that BellSouth has a dividend, so she might use some of it for dividend income. But even at 67, with today's demographics, you might live another 20, 30, 40 years. So you want to have some growth in a portfolio, and I think with that Vanguard 500, she's getting that very thing. Now, if you are younger, you hear that, then you have a little bit more time to make errors, to stay in the market longer, to deal with the ups and downs.
Right.
Now, if she told me that her portfolio was all BellSouth and that she was 67 and she really needed to begin to access that portfolio for living expenses, then I probably would have told her to maybe move out of BellSouth or any one stock for that matter and to go into a Vanguard 500 to get the diversification so that you kind of smooth out the volatility, which is probably of paramount importance to someone in their retirement years.
Very good. We are going to be coming back with more with Eugene Profit, more of your phone calls, also some of his very favorite picks when Talking Stocks continues on CNNFn. of a mixed day on the earnings picture. We're back talking stocks with Eugene Profit, and we go back to the phone calls. And Richie in New York is next. Go ahead, Richie.
Yeah, how you doing? I'd like to know what your long and short is on Ariba and Go Big Blue.
I'm a fan of Ariba from afar. I don't own the security, and it's sort of outside of my PE range. I think it's one of those innovative companies. You could put Commerce One in that space. You can put the JDS Uniphase. I think any one of these handful of companies will do extremely well for you over a 3 to 5 year period. I think in the short term, it's impossible to tell. The earnings are scant to non-existent. They are innovative, and in a slowing economy, innovation is very expensive, and so there's more risk involved, even more so than with an economy that's expanding. But if you're going to own a basket of the B2B type stocks, I think Ariba would be one of them. But just don't let that be your entire portfolio in case you see sell-off like you did last quarter in some of those type names.
What about the argument when it comes to the B2B sector that if the economy is in fact slowing and perhaps more than some expect, that businesses will want to make more use of things that bring more immediate benefits to the bottom line, and that therefore B2B plays are a positive thing?
Yeah, I would agree with that, except for one thing. When you get nervous, you go with what you know. You don't spend money that you don't know what the return's going to be. And yes, we think that long term, the internet and companies interfacing with each other over the internet, bringing down supply costs and the like, is going to be very beneficial to companies. But I think that as you get into an environment where you're kind of in a bunker mentality, you want to get to the other side of the slowdown, you're going to be less aggressive, I believe, in deploying assets in that arena.
A little cautious.
Yes.
A little cautious. All right, we're going to be coming back with Eugene Profit. We're going to be coming back hearing from Rhonda Schaffler down at the New York Stock Exchange. All of that when Talking Stocks continues. We are looking at a relatively flat day, actually, on both indices right now. A little movement. Right now, we are looking at a Dow Jones Industrial Average that is struggling to get above the break-even mark. Rhonda Schaffler down at the New York Stock Exchange with some more details. Rhonda.
Hi there, Bill. You know, sometimes when you have these days where the Dow really isn't budging, there's all sorts of excitement going on in the broader market. Not the case today. Advances and decliners pretty much dead even. So what we're seeing in the Dow is a good reflection about what's going on behind the scenes. There's been a lot of earnings reports out. Nothing, though, to motivate some wide across-the-board buying here. Let's take a look at some Dow movers, because this is where a lot of the earnings reports came from, Dow components. International Paper down just about a quarter here. It reported fourth quarter results of 28 cents, missing street estimates by 2 pennies. DuPont, another Dow cyclical, off by the same amount. Its fourth quarter earnings per share came in a penny better than expectations. Forecast, though, had been lowered already. McDonald's, one of the bigger losers on the Dow, off 1 13/16 right now, missed Wall Street's estimates by a penny on the earnings front for the fourth quarter. And McDonald's warned recently that fear of mad cow disease in Europe meant less people were eating hamburgers there, and that would impact the earnings, and McDonald's standing by that today as the reason why there was a miss on the earnings front. ExxonMobil is fractionally lower. Its numbers blew away the street. $1.46 for the fourth quarter, much better than what the expectations were, only $1.31. One thing with these oil companies, though, the expectations were that that group was going to be the standout winners in this earnings reporting season. So we're not seeing too much movement in those stocks, in the major oils. Some of the drilling stocks, though, performing pretty well. Sector-wise, you've got some decent gains around in financial stocks, the technology